All right. Hello, everyone. This is Catherine Lyons, and joined by Rachel Riley from the Economic Innovation Group. Thank you all so much for joining us this afternoon for a webinar on the second round of proposed Opportunity Zones regulations. I will turn it over to Rachel here in just a second to tell you a little bit more about EIG, but just a couple of housekeeping items just right up front. First, everyone should be muted. However, if just for purposes of being extra cautious, if you wouldn't mind muting yourself while you are not speaking, that would be great. Sometimes our system doesn't quite mute everyone. That'll just make sure that the call will go as smoothly as possible. So thank you for that. To unmute during the Q&A section of our call, which will happen at the end, it is *6 to unmute. There's also a chat box that you can access via the webinar platform as well. Feel free to input questions on that throughout the webinar, and we will collect those and do our very best to answer them at the end of the call, or try to answer them afterward as well. So thanks again for your questions that you submitted earlier too. We will try to do our best to get to as many of them as possible. So I think with that, and last question we get a lot, this webinar will be made, or the recording rather, will be made public to all registrants after the call. So the recording as well as the slides, we'll make sure to circulate that to everyone in the next couple of days. I think that should preempt at least a few questions. So with that, I will turn it over to Rachel to get us started.
Hi, yeah, thank you so much, Catherine, and thanks everyone for joining us. This is, I think, the second webinar in our webinar series here over at the Economic Innovation Group. And just for folks who may be joining us for the first time or as familiar with the work over here at EIG, we are a policy think tank located here in DC, and really the focus of our work is bringing together leading entrepreneurs, investors, economists, policymakers from across the political spectrum to address America's economic challenges. So many of you might know us best through our work with Opportunity Zones, but also wanted to just mention that we do really great work across the spectrum of issues having to deal with economic dynamism and geographic inequality. So please check out some of the great work we've done recently, especially with the Heartland visas, of course, the Distressed Communities Index, and many, many other great research documents and more things to come in the future. So again, want to plug upcoming and previous webinars that we've done to provide information and keep folks in the loop, especially around Opportunity Zones as we move forward in this really critical moment as the market is forming and rules are being implemented. And to that end, here we go with webinar number 2 on the second round of proposed Opportunity Zone regulations. We are so fortunate to have what I think are 2 leading industry experts with us today, Mike Novogradac from Novogradac and Company, as well as Lisa Zarlenga from Steptoe, who are gonna, I think, do something a little bit different with the presentation. So I know everyone has probably gone through to some extent what the second round of proposed regulations has put forth, but I'm hoping today's conversation, and I think it very much will, ground itself more in how does this apply to us, or what are the different scenarios under which we should be considering as we submit comments to Treasury before any rules are made final. And so hoping that this is sort of like presentation 2.0 on the rules and regs. And before we get started, I do want to flag a few recent updates that we want to share with you because it was a busy April, most of which sort of converged around that April 17th date where the second round of proposed regulations came out. There were a number of other things that had happened. I'm not going to go through them now for sake of time, but wanted to include that list for you as a resource once we post the webinar on our website later. But then also wanted to flag that today was really exciting. In the Senate, there was a new bill that was introduced. That Senate bill is S-1344, and this reinstates the original reporting requirements in the Investing in Opportunity Act and goes a step further to expand some investment transparency measures. And so just wanted to also flag that that is a hot off the presses new opportunity zone action item for everyone as of a few hours ago. So Senators Scott, Booker, Young, and Hassan introduced that just today. So again, that is S 1344 to reinstate reporting requirements associated with opportunity zones. And then Catherine, I don't know, you've been so closely ingrained with our Opportunity Zones Coalition, which I don't know if folks know about. This is a membership association of about 80 groups that have been very closely engaged with providing insights and feedback around their work and how the regs, but also a number of other activities have applied to them and how they're thinking about this. What were some of your key takeaways from the second round of proposed regulations? Where do you think we made some progress forward, and how are you feeling after the original analysis?
Yeah, thanks, Rachel. So the second round of regulations, which were kind of highly anticipated over the last few months, that came out April 17th. This was following the first round of regulations that came out in mid-October of last year. And that set of regulations provided some clarity on a few of the kind of more basic issues. But the second round was really important because a lot of investors and communities who were preparing for a potential influx of investment really needed some additional clarity on a variety of key issues, particularly those that would make it possible to incentivize investment into operating businesses, in addition to some of the early real estate deals that we've been seeing over the last year or so since opportunity zones were designated and the funds started to form. And so this round of regulations really does quite a lot to facilitating investments in operating businesses and really recognizing and realizing the intent of Congress for this incentive to really be used with flexibility for a wide variety of projects in a wide variety of places. Again, just a reminder to please put yourselves on mute, especially those who are on the using the video. For some reason, I'm not able to mute some of those folks, so we can hear a little bit of background noise. Thanks so much. Some kind of key bullet points here in terms of what the second round of regulations do. Really providing clarity to investors on some of the timing requirements for initial capital deployment, for reinvestment after the disposition of assets, as well as opportunity fund exits. And of course, we'll be going into all of these in much more detail. It also issued a lot more guidance on the applications of tests throughout the statute, particularly for leased property, but certainly in other contexts as well. One thing that we were consistently asking Treasury for clarity on were really defining key terms and their applications. There's terms like substantial improvement, original use, and substantially all used quite a lot throughout the statute. And we really needed to know a little bit more about what that threshold could look like in several cases. And so they did a good job of kind of defining that. Additionally, it provided some additional flexibility that we needed, again, particularly on the operating business side, in terms of expanding the working capital safe harbor and providing some additional flexibility for meeting the 50% gross income test that essentially requires businesses, in order to qualify for investment, to show that 50% of their gross income comes from the active trade or conduct of a business in the zone. So anyways, just some quick kind of guiding points that we were excited to see included in the regulations. There are still some areas where we need additional clarification. Our comments will certainly focus on areas like that, particularly the substantial improvement test and how that gets applied for businesses. But for the most part, we were really pleased to see how well the regulations mitigated or removed really some of the more significant barriers to investment, and particularly on the business front. So with that, I want to turn it over to Mike and Lisa, and as they have a lot more detail on all of these issues and more, and I think will provide some really helpful context here. So with that, I will turn it over to Novogradac of Novogradac and Lisa Zarlenga of Steptoe to take us through some of the other issues in the regulations in more detail. And again, it's just *6 to unmute.
Great. Thank you, Catherine, and thank you, Rachel. It's an honor to be able to speak to this large group. I know Lisa shares my appreciation for being able to participate here. We do have a number of items to discuss, and we're structuring our discussion as from an operational perspective in terms of looking at the life cycle of a fund. So we'll start with the opportunity fund operations, and from there we're going to walk through the life cycle of a fund. We'll start off at the beginning formation stages, the operating stages, and the exits, and talk about what we think are some of the key guidance clarifications and provisions that were provided. And then we're going to talk about operating businesses and some of the significant provisions where we got guidance in terms of being able to invest in operating businesses and opportunity zones. And then the third segment, which won't be quite as extensive, has to do with real estate. There are a handful of issues that are particularly pertinent to real estate investments or real estate businesses. So starting with the life cycle of the opportunity fund, I want to start at the formation stage. And at the formation stage, there were a couple of provisions that we've been asking for, that we being EIG and sort of broader coalition of advocates for opportunity zones. And that related to how you determine and when you have to count capital that comes into a fund. We all know, those in this call, that there's this 90% asset test at the fund level. And I should actually note that this call does assume a pretty good working knowledge of opportunity zones and opportunity funds and called opportunities on businesses. So we're just going to be dealing with the key provisions that were in the regulations, the second tranche regulations that are the most impactful. And here, when the fund is formed, there's this 90% asset test that you measure after the end of the first 6 months of your time as a qualified opportunity fund, and then the end of the tax year. And the 90% asset tests are hard and fast, and the 90% asset test doesn't include cash, generally speaking, as a good asset. As a consequence, there was a request that cash that's received by a fund, there be some period of time that you have to invest. And the good news is the proposed regulations do allow, when you're doing this 90% asset testing, to exclude cash received within the last 6 months. And what that means operationally is now funds will be able to raise cash and know they have at least 6 months to invest that cash. And depending upon when you receive the cash, you could have up to a year. So basically, if you receive cash in the first 6 months of a calendar year, as a general matter, you'll have until the end of that calendar year to invest the cash. And as a general matter, if you receive the cash in the last half of a calendar year, you'll have until June 30th of the following year to invest the cash. So this was pretty significant. EIG was obviously asking for a full 12 months, but getting at least 6 months and potentially up to nearly 12 months was a pretty significant success. And then there was also, I'll ask Lisa, maybe you can discuss the valuation rule that was added, the optionality. Lisa, are you off mute?
*6 to unmute. I know she was having some technical difficulties earlier.
Oh, okay. I had hit *6 before, but it apparently did not work. Sorry about that. So obviously to apply the 90% asset test, you have to know how to value your assets for purposes of that test. And the original set of proposed regulations had required the use of financial statement values if the fund had an applicable financial statement, which basically is a statement, financial statement is filed with the SEC or some other regulator for the most part. And the coalition and others had commented that that was a fairly burdensome requirement to apply GAAP accounting, particularly if it fell between financial statement dates. And had asked for an elective ability to use unadjusted cost basis, which was the alternative test in the initial proposed regulations if you didn't have an applicable financial statement. And thankfully, the second set of proposed regulations adopted that approach. And so now you can use either the value report on your financial statement or unadjusted cost basis. And that valuation applies both for purposes of the 90% test at the fund level and the 70% test for tangible asset location at the quasi business level.
And I would just sort of layer in on that as a practical matter, all of our clients are going with, or virtually all, I definitely can't say all because I've not talked to all of them, are using unadjusted cost basis. And I would just note that if you were thinking you wanted to use the applicable financial statement approach, it's unclear how you apply that on it because you're supposed to apply it every 6 months. And at the end of the year, most clients won't have these financial statements at the 6-month intervals. And Treasury hasn't really provided guidance, practically speaking, how you can use the applicable financial statements. An unadjusted cost basis, you'll have access to that information. So just from a general sort of management perspective, it certainly seems like unadjusted cost basis will be a highly desirable approach.
Yeah, I think that will be the default for sure.
Right. So moving on to that's a couple of the upfront items, which are pretty significant. Then you move into the actual operation of the fund. And what were some of the takeaways in terms of how a fund could start to operate. And most of the funds that we're working with are going to be partnerships. And a lot of the discussion that when we talk about opportunity funds and stuff will be partnership opportunity funds. We have a handful that are RC corporations, but there's not quite the complexity in C corporations that partnership qualified opportunity funds have. As everyone on this call certainly knows, whenever you're investing in an opportunity fund and making an election to defer your gain, your basis from that initial contribution starts off at 0. And then your basis gets increased, though, by any allocable debt if you're a partnership opportunity fund. And that allocable debt gives you basis in your interest, tax basis, as well as if you have operating income, that operating income gives you tax basis. I'd also note that if you have operating losses that are flowing through, and obviously rental real estate funds will have operating losses coming through, not operating income, then that reduces your basis. And in reviewing the second tranche of regulations, they confirm what we thought the original round of regulations allowed, which is you'd come in partnership, you still have a 0 basis. To the extent the partnership borrows money, you get basis in that if it's allocable to you. And it's important that debt be allocable to you, and that the allocation of debt, the complexities of that, be something that you'll have to monitor pretty closely. You'll get tax basis, and then to the extent you have operating income or losses, your basis will get adjusted based upon those the operating income or the operating losses. You also, if you invest by the end of this year, and or invest by within 2 years of the end of this year, you'll be eligible for a 10% and a 5% basis increase. They come after holding it for 5 years and after holding it for 7 years, 10% after holding it for 5, 5% after holding it for full 7. That does add to your basis, which would increase your ability to take tax losses if you were otherwise suspended, the ability to take losses because your basis wasn't had gotten to 0 because of the prior losses. I will note that you do end up with a inside-outside basis difference, and that's something that a lot of folks aren't also aware that when you make your cash contribution to the fund, you start off with 0 basis under the statute. However, the fund itself is a separate legal entity that has cash, and what it spends that cash on has tax basis. So there's this inside-outside tax basis that, in most cases, by the year 2026, will rectify itself as you get your basis step-ups and you recognize your deferred gain. So this does end up meaning that during the course of the operations, it's clear now that you can distribute cash to investors who are in a partnership opportunity fund, and those distributions of cash won't end up being inclusion events that cause you to recognize some of your deferred gain, so long as you have adequate basis in the fund. So that kind of takes you through the operations concept. One of the big questions we get a lot before those regulations came out is, as we approach 2026, we'd like to be able to make some type of debt refinance distribution to help our investors pay the tax liability that will be due in 2027 by recognizing the gain in 2026. But there was concern as to whether or not a distribution of debt proceeds would be a taxable event or not. And the regulations give a general sort of view or a general statement that distributions of debt proceeds won't be a taxable event to the extent that a portion of that is allocable to you as a partner. Once again, we won't go into the debt allocation rules here, but there's a lot of trapped potential footfalls with debt allocations you have to be really sensitive to. That being said, there is an overall caveat that as a general rule, you can't make debt finance distributions within 2 years of the last contribution to your fund. If there's a capital contribution to the fund and you don't wait 2 years, there's a significant risk that a portion of that capital contribution that was invested in the fund would not be eligible to be a qualifying investment. I don't know very many funds will be making a debt finance distribution within 2 years anyways, because they go through the development phase and the rest. So it's not a significant limitation, but once again, it is an area where there's a footfall potential. So that's my general comments on operation and refinancings. Lisa, if you want to add any more comments to that and or kind of explain the interim gains.
Absolutely, yeah. So the only thing I would add on the distributions is, you are allowed distributions up to the amount of your basis, as Mike explained, and that is not treated as an inclusion event. If the distribution exceeds your basis, that is going to be an inclusion event, and your gain is triggered to that extent. And so you do need to sort of keep an eye on where the debt levels are, because as the debt in the partnership goes down, it reduces your basis accordingly, and so you just need to kind of make sure you have sufficient basis for any, to cover any distributions. Another area where there were a lot of questions after the first set of proposed regulations, because they didn't really provide any guidance, is, what happens if the fund sells assets before the 10-year holding period is over? Will that trigger there's actually 3 potential negative consequences from an interim sale or disposition of assets inside the partnership. First, it could trigger the investor's deferred gain. Second, the flow through of that income to the investor could result in tax liability to the investor. And third, the proceeds from the sale could cause the opportunity fund to fail the 90% asset test. And fortunately, the proposed regulations do respond to all 3 of these questions. First, they provide that the recognition of an interim gain by the fund will not trigger an inclusion event, which was welcome clarification. But the preamble to the proposed regulations clarified that interim gain, the flow through of the interim gain, will in fact be taxable to the partners under normal tax principles. So they, Treasury and IRS, tried to find a way, I think, to exclude that. There were a lot of commenters, including the coalition, that suggested that that gain not be taxable, because effectively you may not be accelerating the actual deferred gain, but you're including an amount of income that could equal the amount of that gain. So in effect, you're accelerating the deferred gain, which is sort of contrary to the intent of the statute. But Treasury and IRS concluded that they didn't have the authority to sort of turn off the normal tax principles, although they did ask for comments in the preamble on that point. And then the third point that was addressed in the regulations is that they do permit the fund to disregard the proceeds from the interim sale for purposes of its 90% asset test if the proceeds are held in cash equivalents, or short-term debt, and they're reinvested within 12 months. So they provide a 12-month period to be able to reinvest the proceeds and not trigger any negative tax consequences to the fund or to the investor with respect to the deferred gain. So that was very helpful guidance, I think, in this set of proposed regulations.
So that takes us through the sort of operations phase to interim sales of assets. Now we move into the exit or the wind up of an opportunity fund. And there's two areas where the regulations gave very helpful commentary and provisions. One has to do with the sale of the opportunity fund interest themselves. In order to get the step up in fair market value, the statute requires that you sell your interest in the fund. And there was a question as to, when you sell your interest in the fund, what if the fund has what are commonly referred to as hot assets, or you have personal property that's depreciated at its value in excess of its adjusted basis. And there is a tax rule that basically says if you sell an interest in a partnership and that partnership has these hot assets, these assets have depreciation recapture, and depreciation recapture means you have to recognize ordinary income instead of capital gain income from the sale of those assets. There's a general rule that would suggest that when you sell an interest, even if you have no gain or loss, you could end up having to recognize ordinary income that's offset by a capital loss. And the good news is that these regulations provide that if you sell an asset or sell a partnership interest, or if you sell a partnership interest, then you're deemed to have a 754 basis step-up election, almost contemporaneous with the sale. And the net effect of all of that is you don't have this potential whipsaw of ordinary income and capital loss. And that's a particularly significant issue in the renewable energy area, where you'll have fully depreciated assets that have value that will have some gain at the end. So that's the outside. And there is also there's a little bit of confusion. I think the general view is that if you sell a partnership interest with debt allocated to you, then your step up is the full amount of your pro rata share of the assets, including the assets that have been acquired with debt. I will note that the regulation itself says kind of a parenthetical about including debt. And there are some that are wondering what that including debt provision means. And I think we need to get additional clarification from Treasury to eliminate that question. And I think most folks believe that you get the full step up when you sell that fund interest, which would translate into avoiding depreciation recapture on rental real estate. The other provision that's the most notable, and the one that was pretty pleasing to see, has to do with an election where the fund itself, after all of its investors have held their investments in the fund for 10 years, if the fund itself sells some of its property, some of its qualified opportunity zone property, and has capital gains to sell that property, those capital gains get allocated out to the investors in the partnership qualified opportunity fund. Those investors can choose to exclude that capital gain from taxation. It basically means that a fund could invest in multiple assets and sell its individual assets and generate capital gain that the individual investors could exclude. Prior to this round of regulations, a large number of our clients were doing single asset funds because you had to sell your interest in the fund. And that simplest way to deal with that when you're dealing with multiple assets is to have individual qualified opportunity funds per asset. Now the fund itself could have multiple assets and it just has to sell the individual assets. Now I will note that most funds are set up as indirect investments where they in turn invest in a qualified opportunity zone business. If that lower tier entity, that business, that partnership were to sell the asset under a clear reading of the regulations, that gain, that income would not be eligible for exclusion. So it does mean that the fund itself would have to be selling its partnership interests and not letting the partnerships they've invested in sell their individual assets. I would also note that there's this hot asset issue that I mentioned earlier. If the fund itself has partnership interests that have this appreciated personal property where you have this ordinary income issue, the fund itself, if it were to sell those assets at some level of ordinary income, that ordinary income would not be excluded under the regulations. So I do think there will still be situations where partnerships aren't able to avail themselves of this election because of the ordinary income that would remain at the subsidiary business level. But all in all, it's a pretty attractive provision to have.
Right, which I will just add, that sort of pushes you back to the single asset funds if you want to sell the co-op interest and take advantage of the stepped up basis to get rid of the hot asset problem.
Exactly.
So it's yeah.
So with that as the sort of the operating life cycle of a fund, now let's go into specific business classifications. We'll start with operating businesses.
I will add before we go into operating,
yes.
before we get into operating businesses, that those two provisions that were really helpful for purposes of exiting the funds, I will just note that the proposed regulations do not permit reliance on that section of the proposed regulations. And so it's a little strange, but the preamble had explained, well, this is, these aren't going to be effective, these aren't going to be needed until 10 years out anyway, so we really don't need to make them effective now or to give taxpayers reliance on it. However, at least we are seeing that, some investors going into the funds kind of want that certainty as to, what an exit strategy is going to look like and would like to be able to rely on those regs. Okay, so now turning
to operating businesses, yes.
Yeah, turning to operating business. So the statute generally requires that a qualified opportunity zone business derive, and this is the lower tier entity under the fund, derive at least 50% of its gross income from the active conduct of a trade or business. They're also required to use a substantial portion of their intangible property in the active conduct of the trade or business, and they're not permitted to hold non-qualified financial property in excess of 5%. There's a exclusion for a certain amount of working capital. So the first set of proposed regulations adopted a very favorable working capital safe harbor that basically provided that all of those
the managers
required.
Okay.
Hello? Was somebody asking something?
Okay.
You should go ahead, Lisa. We'll take questions at the end.
Okay, all right. So the first set of proposed regulations included a very favorable safe harbor that provided that working capital would be treated as meeting all of these requirements, plus the 70% tangible property test for a period of 31 months if it was being spent on the acquisition, construction, or substantial improvement of property in accordance with their written schedule. And so this working capital safe harbor effectively gave qualified opportunity zone businesses the ability to invest the capital in its qualified opportunity zone property. One of the concerns with that working capital safe harbor was that by its terms, it was limited to the acquisition, construction, or substantial improvement of property, which seemed to exclude the ability of operating businesses to rely on that working capital safe harbor. The new proposed regulations expand the safe harbor to apply to the development of a trade or business, which includes, starting up an operating business in addition to the acquisition, construction, and substantial improvement of property. Another thing that the new proposed regulations do is they provide an extension of the 31-month period for delays that are attributable to waiting on the government to act on a completed application. So if you apply for a permit, for example, and you wait for, 6 months to get it approved, you get to basically tack on 6 months to your 31-month period. I will note that extension is pretty limited. It only applies to waiting for the government to act on an application. Many had hoped, I think, for protection against, other delays that are outside the control of the taxpayer. One might look to Notice 2013-29 for some examples of this. That's a notice that applies the begin construction requirement for purpose of the renewable energy tax credit, and it looks at basically any delays that are outside the control of the taxpayer. So it would include, for example, severe weather, natural disasters, labor stoppings, and things like that. And so I think folks had hoped to see, and still might request in the final regulations that they broaden that. One other thing that the proposed regulations did was they clarified, I think the initial set of proposed regulations could nonetheless be read this way, but they clarified that there can be multiple 31-month periods. So every time there's an infusion of capital into the qualified opportunity zone business, the business has 31 months to, as long as they're working in accordance with a written plan, they have 31 months to deploy that capital. And each new infusion creates a new 31-month period. In the second set of proposed regulations, clarify that.
Great, thank you, Lisa. I would just sort of note that these three on the slides you have in front of you, where we talk about the working capital safe harbor, 50% gross income, and intangible asset test, those three technically apply under the statute as drafted at the subsidiary level, at the opportunity zone business level. So it's where a qualified opportunity zone is invested in a partnership or a corporation that is operating a business. Technically, these do not apply at the qualified opportunity fund level. I will also observe that at the qualified opportunity fund level, 90% of your assets have to be in qualified opportunity zone property, which is either partnerships or corporations that are meeting all these other tests, or tangible property itself that is qualified opportunity zone business property. So as a practical matter, at a fund level, you could never have more than 10% in cash, absent the ability to ignore 6 months worth of cash or the 12-month reinvestment cash. And as a practical matter, at the fund level, you can't have more than 10% of your assets be bad assets, and intangible assets would be a bad asset. So there are limitations at the fund level on how much cash you can have in intangible assets, but the general rules we're discussing here don't apply. I will also toss a caveat out there that in the preamble to the regulations, the second tranche of regulations, Treasury specifically asked to what extent these rules, which those of us in the wonky tax side call the 1397 Cap C rules, because that's the code section where they come from. There's 5 tests there, and they're saying that those tests, to what extent should those tests apply at the opportunity fund level? So just know that if you're looking at particular structures where the opportunity fund itself is operating to get around some of these rules, know that future regulations could apply some or all of the 1397C rules at the fund level. So the next item we wanted to touch base on here was the 50% gross income test. This was, a bit of a surprise in the first round of regulations that the IRS determined that 50% of gross income from a qualified opportunity zone business had to be from the active conduct of a trade or business in the qualified opportunity zone. It was the in the qualified opportunity zone that was the challenging part. The good news is there are safe harbors provided, as well as the general facts and circumstances test. The safe harbors, that most I think are going to be relying on is there's a services performed in the zone measured by hours, or there's services performed in the zone by amount paid, and that's going to be something that it should be a bit of a check the box, and you'll be able to easily get comfort as whether you're passing that test or not in most circumstances. The one caveat I would just note there is it's not just employee services, it's also independent contractor services. So you do, if you're going to be investing in an operating business in a zone, and you're looking at this 50% gross income test, you do need to be thinking about what independent contractors you have relationships with, what accountants, law firms, and the like, and get some type of reporting of their hours, just to ensure that there's not so many hours by independent contractors that you would fail this 50% test in the zone in terms of services performed or wages paid. And with that, maybe, Lisa, you can touch on the intangible assets guidance that was provided.
Yeah, absolutely. So the statute in the first set of regulations provide that a substantial portion of intangibles have to be used in the qualified opportunity zone. And they did not, the first set of proposed regulations did not define what substantial portion meant. These proposed regulations define that as at least 40%. We're still sort of left scratching our heads as to how to actually apply that in practice. What does it mean to use intangibles in the qualified opportunity zone? For example, how would it apply to licensing income? But hopefully we will get additional clarification on that in the final regulations.
And I would just note on that intangible asset used in the zone, that there are some examples in the regulations that don't deal with, they're not specifically dealing with this use question. They're related to working capital example, but they contemplate developing software. And you like to think that they wouldn't have an example in the regulation for another provision that was incompatible with another provision of the regulation. And that appears to say that if you invest in a business and that business is going to create a new software or a new application of existing software that will then be used outside the zone, that because the construction development of the intangible asset was in the zone, that it being used outside the zone, it doesn't alter the fact that 40% of it is used in the active conduct of a trade or business because it was developed in the zone. So there is that, that's as much comfort as I could give in terms of analyzing the impact of this. And it's definitely a question we get a lot of right now, and it's going to be one where we're going to need more clarifying guidance, because obviously a large number of technology and companies and the like would like to be developing in an opportunity zone and or move into an opportunity zone, and we need to know what does and doesn't qualify.
Right, absolutely.
So another item that was pretty significant for operating businesses and a whole host of other potential users is the clarifications on leased property. And leased property was a difficult issue because the statute doesn't address leased property very clearly and has some implications that Treasury had to work their way through. The Treasury basically ended up concluding that, in short, you treat leased property as if it was owned or acquired or purchased tangible property. And generally speaking, you'll end up looking at the leased property and doing a present value of your lease payments, either under the alternate valuation method or through the use of applicable financial statements that have some type of present value type of calculation. But essentially, that stream of revenue you end up present valuing, calculating, and that gets treated as new property. And you don't have to worry about, because most leased property will have been used by somebody else before, and as a consequence, it'll be used property in most common parlances, but here it'll be considered new property. You just have to enter into the lease after December 31, 2017. And then I would also note that there's some additional rules for related party leases. We're going to run out of time here, so I'm going to skip discussing that. Just say it was a pretty favorable rule, which will allow a lot of businesses to start in opportunity zones or move into opportunity zones, and the present value of the lease stream will get you a long way towards meeting the 70% test.
I mean, I don't have to do everything, just be there with us.
And we are getting some background noise, and with that, I'll hand it to Lisa to discuss original use or substantial improvement.
Thank you. So in order to be treated as qualified opportunity zone business property, tangible property held by either a qualified opportunity fund or a qualified opportunity zone business generally has to be acquired by purchase after December 31st, 2017, and also has to satisfy either the original use test or the substantial improvement test. The first set of proposed regulations didn't provide any guidance as to what was meant by original use. And so I think a lot of people were assuming that it would be a relatively limited application, that it had to be the first use overall, like you're the original owner of the property. But what these regulations provide is that original use is the date that the taxpayer first places the property in service in the qualified opportunity zone. And this is for purposes of like claiming depreciation or amortization. So basically, even if the property has previously been used outside the zone, if this is the first use that it's being put to in the zone, then it qualifies as original use, which I think was a very welcome interpretation of original use. The property generally is treated as substantially improved if during a 30-month period beginning after the acquisition of the property, the fund makes additions to the basis of property that double the amount of the basis that existed at the beginning of the 30-month period. The proposed regulations provide a couple of clarifications here. First, they clarified that the substantial improvement test is applied on an asset-by-asset basis, but do ask for comments as to whether an aggregate approach might make sense the coalition had commented that an aggregate approach would be favored, and other commenters did as well, particularly for operating businesses, because it's going to be nearly impossible to satisfy any sort of substantial improvement test by an operating business. And I think the other clarification that was made was with respect to real estate, but I think we'll get into that on the next slide.
Right. So now we wanted to touch base on real estate, and one of the good clarifications in the real estate is there was a confirmation that ownership and operation of real property, including leasing, constitutes the active conduct of a trader business. And this active conduct test is one of those 1397 Cap C tests that apply at the opportunity zone business level, and under this statute does not apply at the qualified opportunity fund level itself. At fund level, it does have to be used in a trader business. It's just technically the active conduct test doesn't apply at the fund level. But as I noted earlier, Treasury may decide to apply that test at the fund level under some type of anti-abuse rule. I'd also note that the regulations also create this, have a statement there that says merely entering into a triple net lease of real property is not active conduct. So we've got lots of questions as to what merely means, what a triple net lease means, and why they reference real property and not personal property. And we can't go into all those discussions. I just want to point out some of those complexities there for you to be thinking about with your own business model.
Right.
Lisa, 1231 gains?
Yeah, so Section 1231 property, it generally consists of depreciable property that's held for use in a trader business. And it receives special treatment under the tax code. So if your net 1231 gains are, if your net 1231 gains and losses result in a gain, then that gain is going to be treated as long-term capital gain, which is generally more favorable. If it's a loss, then the losses are going to be treated as, then the 1231 gains and losses will be treated as ordinary, which again is favorable. And so there was a question after the first set of proposed regulations, which clarified that only capital gains are eligible for deferral under these provisions. A lot of people ask, well, what about 1231 gains? And these regulations clarify that net Section 1231 gains are eligible for deferral under the Qualified Opportunity Zone rules, because once you net your gains and losses, and if you have a net gain, it's going to be treated as capital under the code. Sort of the caveat to that is, because you can't determine what your net 1231 gains and losses are until the end of the year when you know what all your 1231 sales look like, the proposed regulations provide that the 180-day period for investing those gains doesn't begin until the last day of the investor's tax year. And while that might seem favorable in some circumstances because it gives you more time, in other circumstances it may not be so favorable. For example, folks who have already made investments even before these proposed regulations came out of 1231 gains, because effectively this sets up a scenario where if you're looking to rely on the proposed regulations, then you're basically looking at December 31st, 2019 to be able to compute your 1231 gains and losses, and your 180 days will run from then, which basically means that you're talking about an investment in 2020, which will effectively eliminate the 7-year holding period basis step up, because you'll only have a maximum of 6 years to qualify for the deferral and the other benefits. So it's a little bit of a trap for the unwary, and I think the hope is that the government might be able to provide some relief similar to what they did for the election with respect to partnership level capital gains that flow through to the partners, where they basically gave partners the ability to run the 180-day period from either the end of the partnership tax year or the date of the sale. And I think folks are hoping that they might adopt a similar rule here for 31 gains. You want to talk about original use, Mike?
Yes. So the last item I wanted to talk about with respect to real estate is original use or substantial improvement. Once again, we are getting some background noise from someone who's having a conversation in their office. The The first item is that the definition of original use is placed in service. And the reason why that's useful is if you had a property under construction and then you acquired it while it was under construction, it wouldn't be used in the zone yet. So that was a good clarification, because we definitely have clients that are out there buying properties that are under construction and want to ensure that they're going to meet the original use test. The next rule, they did provide that property, and most notably it's going to be buildings, but it does say property vacant for 5 years and unused, and it can't be used, it has to be unused on an uninterrupted basis, which will create some interesting documentation issues, as well as what types of unintended or unallowed or unknown uses might cause an issue, so you have to be very sensitive to that. But if it's been vacant for 5 years, it'll meet that original use test. Many, the coalition itself, we're asking for a 1-year vacancy rule. And Treasury basically said they were afraid that if they had a 1-year vacancy rule, building owners might actually intentionally not lease their properties for a year so that they could meet the original use test. So I think the 5 years was a way to avoid that sort of planning. And then the last item, after the first round of regulations, there was still confusion about unimproved land. And I think the regs tried to address this issue by saying more clearly that no substantial improvements required for unimproved land. So that definitely made, if left alone, that would have made the issue a little bit less ambiguous. The problem is, and there's many areas in the regulations where, because opportunity zones incentive apply so broadly that different issues kind of overlay, there is a anti-abuse comment that Treasury makes in the regulations. And they say in the regulations that if land is unimproved or minimally improved, so if you actually don't improve the land or only minimally improve the land, and the land was bought with an expectation not to improve the land by more than an insubstantial amount, then it doesn't qualify. So that's definitely caused a lot of consternation in terms of what does that mean in terms of do I or do I not have to improve land? And I think the better reading of that anti-abuse rule is there has to be additional economic activity with respect to the land. And land has to be used in a trade or business to be eligible at period. However, what Treasury didn't want to have happen, I believe, is you buy land that's being used in a trade or business already, and that trade or business, there's no differing economic activity with that trade or business. And this could happen most likely in an agricultural context where you buy existing land. And so they want to see that there's some level of additional economic activity. So I don't think you need to worry about land where you're building a building on top, but I do think you have to be sensitive to buying land where you're not changing the economic and enhancing the level of economic activity post-purchase.
Right, and the preamble also clarifies that kind of factual scenario might run afoul of the general anti-abuse rule as well. So, I mean, it really does seem like a concerted effort to get at land banking so that you're not just kind of buying up land.
Right. I do think that emphasizing that general anti-abuse rule, I mean, the Treasury does have the ability to recast a transaction or series of transactions to achieve the tax results consistent with the purposes of the Opportunity Zone statute.
That's why.
And so there is this overriding anti-abuse rule that you always have to be very sensitive to when you're structuring transactions.
Yeah, and I guess there's also hope too, because that anti-abuse rule is drafted really broadly, and the only guidance as to what it might mean is that preamble example. And so there's nothing in the reg itself that has examples or guidelines as to how they might apply that in the future. And so, that might be a little bit of cause for consternation as well.
And that's also a good transition into Q&A, because one of the questions that were submitted in advance was, what are we still waiting on? And I would say two areas that we're still waiting on is reporting, as we all know and are all very sensitive to, but the other is anti-abuse. There needs to be more guidance, and we expect there to be more guidance on anti-abuse, and what are the consequences of losing your Qualified Opportunity Fund status? What do you have to do to lose your status? And what are the consequences of losing your status?
Yeah, and whether you can lose it, I mean, because really the statute only provides for a penalty. The preamble to the proposed regulations asks for comments on that and indicates that they'll provide guidance in the future. But it's interesting because the statute actually doesn't set up a decertification process.
Great.
No, I can't actually
Catherine or Rachel?
questions. Yeah, I can't actually see any of them, so.
Oh, sorry. Yeah, thanks, Lisa. And yeah, thank you both so much for walking us through that. I know that the regs were, for context, 169 pages, so quite detailed and quite comprehensive. And thank you so much for taking us through some of the highlights and the key issues and sharing your expertise with us. So just as a few next steps before we jump into Q&A, so I want to reiterate a few different timelines and deadlines rather related to the second round of regulations and some of the accompanying documents that Rachel mentioned at the top of the call. So the first is the second round of regulations posted to the Federal Register on May 1st, and so that kicks off the 60-day comment period. So comments are due on July 1st. If you're interested in submitting them, please do so by then. As we mentioned and alluded to on this call, our Opportunity Zones Coalition will certainly be doing so. And we really encourage everyone to participate in that process. I think it is valuable for Treasury and IRS to hear what folks need in order to move forward with either setting up a fund or investing or deploying capital or receiving capital through this incentive. At the same time, if you are interested in speaking at the July 9th hearing, which will be out in Maryland, I think that we had so many people or IRS had so many people come to the first hearing that they actually had to find a bigger space for the second one. So that'll be out in the Maryland area. And if you would like to speak, you would need to submit an outline of your comments by July 1st alongside any comments you have on the regulations as well. The RFI on data collection, I think which was mentioned, that Treasury and IRS also released a request for information on data collection and tracking of Opportunity Zone investments. Those comments are due on May 31st. It's only a 30-day comment period. And then finally, the RFI from the Department of Housing and Urban Development on just how to maximize HUD programs with Opportunity Zones are due on June 17th. So with that, I will open it up to any questions. I'm having some technical difficulties, which is unfortunately why we're hearing a little bit of background noise as well as unfortunately I'm having trouble muting folks. I'm sorry, okay. Yes, we are on a webinar of Opportunity Zones. I'm also having a trouble seeing the chat. So if anyone submitted comments via the chat, I'm sorry that I'm having a hard time seeing that. Mike and Lisa, I don't know if you can see that and wanted to try to address some of those questions. But otherwise, we can just open it up to the floor, and it's *6 to unmute.
Yeah, I can see them, but we want to open it up to folks asking a question. I will say that there were questions submitted in advance, and one had to do with, could you invest in an opportunity fund without eligible gains? And the answer is yes. An opportunity fund can receive investments from those that aren't making an election with respect to their interest. However, the investor will not get the benefits. They won't get obviously any kind of space to step up because they don't have deferred gain, and they won't be able to exclude any gain for holding their investment for 10 years. So
great. So I do see somebody has, I see somebody has raised their hands using the webinar platform. Louis Zahner, if you wanted to unmute *6 to ask a question, go ahead.
Hi, can you hear me?
Yes.
So can you purchase qualified Opportunity Zone property in a QOF, let's say using debt, and then put in the deferred capital gains later?
Yeah, I think from the fund standpoint, a qualified opportunity fund is free to borrow money, and they're free to use that borrowed money to buy Opportunity Zone property. and there's no tracing requirement for capital contributions into a fund, that cash itself has to go directly into opportunity zone, qualified opportunity zone property. So I do think as a general matter, investing, having a fund use debt to buy opportunity qualified opportunity zone property, and then have that debt be repaid by capital contributions from investors is allowable. I will just note, though, that you do have to ensure that the debt's treated as debt for tax purposes. You have to ensure the partnership of qualified opportunity fund exists as a separate legal entity, and there's a host of substance over form questions that you need to be navigating quite carefully.
Right, and you also want to look at the timing too, right? Because you got to satisfy the 90% test. Looking at when the qualified opportunity fund is going to elect to start its, its self-certification. So it can designate the month in which it starts to be treated as a qualified opportunity fund. And so do you want to start it, when they acquire, I guess when they acquire the property would probably be fine. But you just want to kind of look at what its asset base is going to be on the relevant testing dates.
So make sure you pay the applicable federal interest rate and all that.
Yeah, that goes to the point of that Mike made about treating it as debt for tax purposes as opposed to equity.
Thanks.
Great. We have one more raised hand from Jamari Peterson. Go ahead and unmute to ask your question. *6.
Hello, can you hear me?
We can.
Yes.
All right, excellent. Good day. Yes.
Yep.
So my question was really about the substantial improvement portion, because I've heard some people talking about strategies around that, and I was trying to understand that case by case basis portion, because I even wrote about it. Like I heard some talk about some people saying, oh yeah, well then substantial improvement could be like I buy a parking lot and then I put art on the parking lot, and then therefore if the art's valuable, then therefore I've now increased the basis of my property. From your understanding, is that a viable strategy that they're talking about? Because I was really worried that is.
So what, I'm sorry, you purchased a parking lot and what did you put on the property?
Art. Like you buy expensive art and you install.
Okay. Well, interesting. There's a, and this kind of goes to the anti-abuse pieces of it. There's a rule in the proposed regulations that you don't have to substantially improve land. It's not clear. I think you can substantially improve land, but although there's not much guidance on how that will work under this. But not putting in an additional additional capital into the land could cause you to run afoul of either the general anti-abuse rule or the sort of the backdoor anti-land banking provision that says you can't rely on the provision that says you don't have to substantially improve land if you have no intent to substantially improve land. So I think there are some guardrails against that, and it's not entirely clear, but it's not entirely clear what it will take to substantially improve land.
Yeah, I think under the regulations themselves, as they were released, that one of the threshold questions to your fact pattern is, has that land been improved by more than an insubstantial amount? And what you described to me doesn't necessarily sound like you've improved the land by more than an insubstantial amount. So right. I would be concerned about that.
Great, and I know we're running a little long on time, so Mike and Lisa, please just let us know when you have to hop off. But we'll take maybe a few more minutes to answer the remaining questions that I'm seeing at least. I know that there are quite a lot more, but we'll do our best to just get through a few more here, if that's okay with you all. So I see a couple more hands raised from Andrew Dupe. If you want to go ahead and unmute, you can ask your question.
Hi, can you hear me?
Yeah.
Yeah.
Okay, thanks. In depreciation, that is taken by the partners in the fund subject to recapture if they are receiving a step up in basis on the sale after 10 years?
Yeah, that's a critical question. And I think in the partnership qualified opportunity fund context, I think the general view is that you step up your basis equal to the selling price of your interest, including debt assumed as being part of the selling price, which is a wonky tax way of saying, no, you do not have depreciation recapture. But I will say that the way the regs parenthetically say including debt, that interpretation is entirely free of doubt. And we're hopeful to get some public comments from some of the Treasury to make that interpretation free of doubt. I don't know what you would layer onto that, Lisa.
Well, I guess I would sort of look at the rule about the, so if you're selling the interest, you can make the election to step up the inside basis so that you don't have the depreciation recapture effectively. So that would be another option.
I would just say in that option, the question depends on when you step it up to basis, does that basis include debt or not? And that's the area where I thought the regulations are fairly clear that when you step up the basis, you step it up to the basis that you would have, both in terms of the cash you get as well as the debt assumed by the buyer. But some have suggested that maybe you only get to adjust your basis to the amount of cash you receive and not the debt assumed by the buyer, in which case you would get a pretty bad result.
Right.
Next question.
Isa Abdur Rahman. Yeah. Isa, if you want to unmute yourself.
Sure.
I see your hand raised.
Sure. Thank you very much. So after the first round of rules, the IRS included that year 2047 kind of sunset provision, and comments following that initial draft, several folks wanted that removed. Obviously, they did not remove it in the second round of rules. Does EIG desire to see that sunset year change or be removed at all? And if so, why? If not, why not?
Sorry, that was the sunset year from 2026. Is that the date that tax needs to be recognized?
Yeah, but the first set of proposed.
I think the question has, go ahead.
Yeah, no, go ahead.
I was going to say, I think the question has to do with the fact that the ability to make the election isn't in perpetuity. It's through 2047.
Right.
It basically means you'd have to exit your investment in the fund by the end of that year, or else you wouldn't be able to avail yourself of that. And I'll just say, within I sort of personally, when you look at that, it is so far into the future that it really hasn't been much of an issue that our clients are concerned about. They were concerned about it being 2028 or 2029 or 2030 or something of that nature. But once you get out that far, I think everyone's looking at that saying that's not a concern to me now.
Right, and plus now that you also have the proposed rule that you can sell assets instead of the interest, so you can at least start recognizing the benefits of the 10-year step up.
Got it. Okay, thank you.
Yeah, and just in case that wasn't the answer you were looking for, maybe I'll offer a little bit of good news, which is we do anticipate some forthcoming legislation on the deferral date, or at least proposing a one-year extension of the deferral date. So currently it's set at 2026. And so it's contemplating a one-year pushback to the end of 2027, which would allow folks to have one more year that they could take advantage of that date. So not exactly to your question, but good news nonetheless.
Sure, that's helpful. Thank you.
Sure thing. So we'll just take a couple more questions and then have to cut it off since we are generously still using Mike and Lisa's time. And thank you all for remaining on the call. So Brent Brent Schmidt, if you wanted to take yourself off mute, you can ask your question.
Hi, my question is about operating businesses. For the 50% gross income test in the qualified opportunity zone, does that have to be in one opportunity zone, or can it be in multiple opportunity zones? For example, if you had multiple locations for your business.
Yeah, Mike Novogradac here. I mean, my view is it would be multiple locations. It would be where the employees are, and are they in multiple opportunity zones. You can easily see a circumstance where you have neighboring zones, and the answer can't be that you have to measure only one or the other. And then similarly, if you had multiple zones that are maybe a bit scattered, that the better reading should be in multiple zones. But I wouldn't say that's entirely free of doubt.
It's not, yeah, I would say I don't think there's any guidance on that. I don't think the statute addresses it, I don't think the regs address it, but they don't preclude it. So I would say, I would agree with Mike. I think that probably the better answer is that it's just got to be in an opportunity zone.
Okay, thank you.
And I would just say from a interpretation question, there are a lot of areas within the statute where it says in the zone. It doesn't say in zones. And I don't think there's any conscious decision to say zone or zones. And that is something that it's going to just develop some sort of common practice in terms of these various sort of provisions. And there's other areas of the statute, locally attached written and the like, where you have questions of building versus project and similar sorts of definitional issues that an industry practice sort of develops around. And then Treasury gives enough guidance that we can comfort around it. But that's a very good question. Thanks for asking it.
Thank you.
Yeah, thanks for that. Okay, last question. We'll aim to end at 3:15 here. Ashley Tisson, sorry if I'm mispronouncing that. Go ahead and unmute and ask your question. Thanks.
Am I unmuted?
Yes.
Okay.
You are.
This is relating to an existing operating business in an opportunity zone, and to the extent that it wants to do an offering, it seems that it would have to improve each of its tangible assets by double its basis, which would, like we talked about earlier, would be next to impossible. Could you accomplish the same effect? And this kind of goes into that previous question on the specific language about the zone versus zones in general. Could you accomplish it by moving it from one zone to another? Because it would technically be new in a new zone. But it would seem that it would, if you can't do that, that it would almost preclude an existing business from being able to do anything on its tangible property.
So I think that's a great question as well.
Yeah.
If an operating business is not in an opportunity zone already, then I think it is pretty clear you can move it into an opportunity zone and meet various qualifications. However, if you're already in one opportunity zone and you move to another, I would be concerned that under the anti-abuse rule, that the IRS would say that doesn't qualify, because the idea here isn't to take businesses away from one opportunity zone and move them to another. The idea is to, so they wouldn't want to create an incentive that indirectly accomplishes that result. I will also just note that if you're investing in an existing opportunity, an existing business, and you want it to qualify as an opportunity zone business, just note that you'd have to look at their assets, and some of their assets might qualify already because they might have been acquired after December 31, 2017, and or you have to look at their lease and the rest. And then the way in which you could qualify is to the extent that you did a substantial improvement in any particular asset, then the substantial improvement cost would qualify, as well as the underlying cost of the asset. And as a consequence, that would help you towards a 70% test, but any new assets would qualify towards a 70% test, and you just have to get over that 70% tangible property threshold. So I do think you'd have to have significant additional investment, a significant additional tangible property. However, I don't think the fact that, and that's a good thing, that's what the incentive is designed to do. It's not designed to just to invest in existing businesses that aren't doing something notably enhanced. It's just a question of doing the math to figure out how to get that business to qualify and how much that would have to be.
Right, I think that's
Yeah,
right.
okay.
I've seen the question before of like the leases, because the lease only has to be entered into after December 31st, 2017. And so I've gotten the question of, can we just re-enter a lease? And I think, Mike, your point about additional capital being put into it in order not to run afoul of the anti-abuse rule, I think is probably a significant point, is that you got to be putting something more into the zone rather than just continuing your existing operating business.
And a follow-on question to that, if you do a stock issuance and it's significantly above, what the actual tangible value of the property is, and or the improvements that you're putting into the zone, can the owners take some of that as a redemption of stock?
So, so are you talking about a situation where you have a qualified opportunity fund that's set up as a corporation?
Well, so in this case, the Qualified Opportunity Fund would be investing into Qualified Opportunity Zone business stock that is a corporation. And it would be effectively buying the newly issued stock, and then part of the cash that would be going into that newly issued stock would be redeeming the existing shareholder stock that are there, almost like a purchase.
I'm concerned about that type of structure, because under the statute, if you invest, a qualified opportunity fund has to invest at original issue into the corporation or the partnership, invest cash. And if all the partnership or corporation did with that cash is turn right around and redeem out existing partners or shareholders, I think the IRS under an anti-abuse rule, and it's not just a substantive reform argument, they have more broader authority than the anti-abuse within the opportunity zone statute to say that's not what this is intended to do. And I think they'd have a pretty strong argument that all this was a sale of an existing business or part of an existing business and didn't create additional economic activity in the zone. So I would
right.
Yeah,
I mean,
that
in a partnership context, you've got the disguised sale limitation, right? You can't have the money go in and then come back out, because you sort of raise the disguised sale problem. I guess you don't have technically the same problem in the corporate context, but I think effectively you have some guardrails in the anti-abuse.
Thank you.
All right, I think we got through all of the hand raises. Apologies that we didn't get to some of the chats, but thank you all so much for joining us today, and thank you again to Mike and Lisa for your expertise and for sharing that with us. Just another reminder that this was recorded. We will be sharing this recording along with the slides after this call in the next few days, so look out for that. And thank you again for your questions and for your engagement on this. I believe all of you should have my contact information as well. So if you would like to reach out with any additional questions, please feel free. Thanks again.
Thank you. Thanks everyone for dialing in.